Welcome to today's class. Today we are going to be looking at variance analysis. Here we are going to be talking about standard costing. We are going to be talking about standard costing and all that relates to it. So in that regard, we'll look at the meaning of standard. Standard simply means benchmark. Then standard cost is actually the expected cost that we expect or look out to incur during the production process. Now, standard cost is the predetermined cost of carrying out an operation or producing a good. Aside all this, standard costing, all units produced are recorded in the cost account and are stated at standard cost. Standard cost is per unit, while budgeting is total. Budgeting cannot be prepared unless standard cost is first ascertained, and standard cost is usually prepared through experiences of the management. Then what are the uses of standard costing? Standard cost is used to prepare budget, as I said. Standard cost is a system of performance measurement. It is an alternative system of cost accounting. Standard cost is a system of control, reporting, and management can use this information to examine whether control is in proper process or not. How do we derive standard cost? We derive standard cost actually by preparing standard cost card. The standard cost card will show the standard cost per unit of material, the standard cost per labor hour, the standard cost to be absorbed as variable and fixed production overhead, and the total of each standard cost will give us standard cost. So that is how we derive standard cost. I would have presented an illustrative example, but there is no need. Then let's look at it here. I presented it. It's a company manufactures two products, Laura and Hardy. In year one, it budgets to make 6,000 units of product Laura and 2,000 units of product Hardy. Budgeted resources per unit and cost are as follows. So they are now telling us that to produce Laura, we will use 3 kg of material X and 1 kg of Hardy. We'll use 2 kg of Y and 6 kg of Y for Hardy. Direct labor hours 1.6 hours for Laura, for L'Oreal, and 3 hours for Hardy. Then the cost for material labor are 13 naira, 14 naira, and 250. The variable production overhead is absorbed at 15 naira per direct labor hour. Fixed production overhead per unit are calculated by applying the direct labor hour absorption rate to standard labor hours per unit. Using the budgeted fixed production overhead cost of 1,800,000 for the year, we are required to determine the standard cost. So we must derive the standard cost per unit for L'Oreal and Hardy. So it's an explanation. It requires that we calculate the standard cost per unit. There are two products, L'Oreal and Hardy. There are two direct materials, X and Y. Product L'Oreal requires 3 kg and 2 kg of material X and Y. Product Hardy requires 1 kg and 6 kg of material X and Y. So all these explanations were given. Then in 4, I calculated the fixed production overhead absorption rate. When I did that, I now say 1.8 million, which was given to us here, divided by the total labor hours. How do we get total labor hours? 6,000 for L'Oreal multiplied by 1.6 per unit, 2,000 multiplied by 3 hours. So this will give us 15,600 if you add the both. So that was how I got this 15,600. You understand? Good. So we now have our overhead absorption rate per hour is 115 naira. Now, to show you how this was gotten, it is important that I show you how it was gotten. So you open bracket, you say 1.6 multiplied by 6,000, you close bracket plus another bracket open, 3 multiply by 2,000. You see, that is how we got our 15,000 units. So this will give us 15,600 hours. So the total budgeted labor hours, so this is what we call total budgeted labor hours will give us this. So we now have the cost per kg we are also given, so that wouldn't be an issue. So I use this table to buttress our points. It has a working inherent in it. So I'll focus on Laurel and forget about Hardy. So you study it by yourself when you go through the class and read the note also. Direct material X. For Laurel to be produced, Laurel will consume 3 units of X. So what is the standard cost per unit of X? 30 naira. So multiply, you now have 90. So the cost of X for Laurel is 90. For Y, Laurel will consume 2 units. Then the standard cost per unit of X of Y is 40. Multiply, we have 80. Direct labor, Laurel needs to produce 1 unit of Laurel. It needs 1.6 hours, and we pay an hourly wage of 250. So multiply, we have 400. Variable production overhead will be absorbed. 15 naira per direct labor hour will give us 80. Fixed production overhead, we already calculated the overhead absorption rate to be 115. Multiplied by 1.6 will give us this. So the addition of this all will give you the standard cost. So you can see it's standard cost. So that is how it was derived, standard cost. So this is how we derive standard cost. I hope that makes sense to you now. So when you go through the notes, you solve for Hardy. It is there just to go through it and know why the figures were used. And please do not forget to ask your questions if you are confused. Then there are 4 types of standard cost. There are 4 types of standard cost. There are 4. The first one is ideal standard. The second one is attainable standard. The third one is basic standard. The fourth one is current standard. Ideal standard is actually that standard that is prepared without considering wastage. Without making provision for wastages, idle time, machine breakdown, and all that. This is also called unattainable standard. Attainable standard, this is a standard actually that can be attained because provisions were made for wastages, idle time, machine breakdown, transportation challenges, unavailability of materials. Those wastages that would arise as a result of non-fault of the workers. Now, basic standard, this is a standard that is prepared at the commencement of the year and is not reviewed until the year end. So it does not change. In fact, it is a standard for a long period of time. Current standard, this is a standard that reflects the current operation position of the entity. So move to number 2, introduction to variance analysis. Standard cost card. The variance analysis, the standard cost will be presented in a standard cost card. And standard cost card was the first question we solved. Before we solved this question, the question was given in a standard cost card. This is what we call standard cost card. I hope that makes sense to you. So with this said, we'll now move down to the next items. This is standard cost card. You see, direct material is 5 kg at 1,000 naira per kg, 5,000. What this means is, to produce the finished goods, we will use 5 kg of raw materials, and each kg is cost 1,000. So how much material we're going to be using to produce one finished goods is 5,000 naira worth of material. So this is how standard cost card looks like. So I wouldn't waste much time here, so we'll progress further. It is fixed budget. A fixed budget is a budget that is prepared from the beginning of the year and is not altered until the year end. So when we talk about fixed over a budget, this budget is actually there as a guide, telling us where we started from, telling us what has changed at a glance, Then flexible budget. This flexed budget, this is a budget that is flexed, adjusted to reflect the actual activity at the standard cost. Flexed budget brings the fixed budget and the actual result at the same pedestal of comparison. You can't compare a first class student with a third class student. Now, if you must compare them, you must bring them at a playing ground where they can compete favorably, where they can conflict. So we'll talk about still on that flex budget. So now flex budget, we prepare the fixed budgets using actual units produced and sold. So that is that for that. So we have cost variance. The cost variance can be classified into two: favorable and adverse. A variance is said to be favorable when it can increase income, and is said to be adverse when it can increase loss. So that is that for that. So we'll move on to the next one: direct material variance. So this is where we'll now start calculation. Now there are three things we're going to be looking at: cost variance, price variance, and usage variance. That is direct material price variance, direct material cost variance, direct material usage variance. So I will now be talking about it. This is the difference between the standard cost of materials and the actual cost of materials. So this is the difference between the standard cost of material and the actual cost of material required to produce the finished goods. So the formula for cost variance is standard price of material per unit times standard quantity of material per unit times actual units produced minus actual price of material times actual quantity of material times actual units produced. So you see, I gave the interpretations. So when you start making use of your notes, start reading your notes, you would understand the abbreviations better. Now we'll continue. Move to price variance. This is the difference between the standard price of material purchased and the actual price of material purchased. Like, we can set the price of material to be 5 naira. Then we got to market and bought it at 6 naira. So that is why we're looking at the differences between our standard price and the actual price. So the formula is standard price minus actual price. Standard price minus actual price. Standard price minus actual price. Standard price minus actual price, where SP is standard price, AP is actual price, then actual quantity purchase. Then usage variance is actually the difference between standard quantity used and actual quantity used to produce the finished goods. The formula is standard quantity. I hope you can see the formula here. The formula is standard quantity minus actual quantity times standard price. So we now look at this question. A unit of products P has a standard cost of 5 liters of material A at 3 naira per liter. The standard direct material cost per unit of P is therefore 15 naira. In a particular month, 2,000 units of product P were manufactured. This used 10,400 liters of material A, which cost 33,600. Calculate the difference. Calculate the material price, usage, and cost variances. Now, I will explain this question. Listen. To produce 1 unit of product P 1, 2, 3, we would incur 3 naira. To produce one product, we will use 5 liters of material A, and each liter is sold at 3 naira. So to produce one finished goods, it will be 3 times 5, which will give us this 15 naira here in a particular month. Now, we actually produce 2,000 units. This used 10,400 liters, which costs this value. So you can see the actual started in a particular month. So we'll start first by computing price variance. Price variance, you bring in the formula. The formula is SP minus AP times 8QP. So now where standard price per material, that is what you bring out. Standard price per material is 3 naira. Actual price is what? The actual cost to incur of 33,600 divided by the number of material we bought will give us the actual price. Now you can see that this is always within the same range. The actual quantity purchased is 10,400. It's in the question. You substitute in the formula. You now have this. So when you substitute, you have 3 naira minus 3.230 times 10,400 will give you 2,400 naira adverse. Now, this is just an introductory part of what we are doing. In that regard, we have direct material usage, standard quantity minus actual quantity times standard price. Now, where standard quantity is 5 kg, remember to produce the actual units, to produce the standard units, we must use 5 liters. So since we have actual of 2,000, what is standard unit we use? Standard liters of material. We use 5 kg times, which will give us 10,000. Actual quantity is 10,400 given to you in the question. So you substitute. When you substitute, you have this 10,000, which is the standard quantity, minus 10,400 times 3. So this will give us 1 to adverse. So you now come and get your, that is all right. So you now come and find your direct material cost variance. Your direct material cost variance, using the formula, you now substitute. 3 naira is the standard price of material. 5 is the standard quantity of material. Then actual quantity produced is 2,000. So that will give you 30,000. And the actual cost is 3,600. So when you minus, you have 36 adverse. So if you add this value 12 plus 24 to give you 36. So this tells us what we have done is correct.